No one called it a crash at first. In fact, most people didn't even realize the housing boom had already broken. It did not happen all at once. There was no single day when the housing boom collapsed, no dramatic headline that marked the exact moment everything changed. Instead, it began quietly, almost invisibly, buried beneath numbers that still looked strong to anyone not paying close attention. Prices were still high. Listings still moved, at least on paper. But beneath that surface, something fundamental had shifted, and those closest to the market could feel it long before the data confirmed it. In the early years of the boom, the story had been simple. Demand surged beyond anything the modern housing market had experienced. Low interest rates pulled millions of buyers into the market at once, many of them convinced that waiting would only make things worse. Homes sold within days, sometimes within hours. Offers came in far above asking price, often without inspections, sometimes without even a physical visit. It was not just a competitive market, it was a psychological shift. Buying a home stopped feeling like a financial decision and started feeling like a race against time. As prices climbed, the narrative reinforced itself. Rising values attracted more buyers, not fewer. Investors entered aggressively, convinced that appreciation alone would justify any purchase. Institutional capital followed, converting entire neighborhoods into rental portfolios. For a time, it seemed like there was no ceiling, only momentum. But markets built on momentum are rarely stable. They depend on a fragile balance of belief that prices will continue to rise, belief that buyers will always be there, belief that risk is manageable. Once that belief begins to weaken, even slightly, the system starts to behave differently. The first cracks did not appear in prices, they appeared in behavior. Open houses became quieter. The crowds thinned, then disappeared. Agents who once managed dozens of offers on a single listing began receiving only a handful, then sometimes none. Sellers who expected bidding wars found themselves negotiating instead. Concessions, once unthinkable, started to return, closing cost assistance, repair credits, price reductions after inspection. Small changes at first, easy to dismiss as seasonal variation or local anomalies. But they were not isolated. Across multiple cities, the same pattern emerged. Listings stayed active longer. Days on market, once compressed to record lows, began to stretch. At first it was a matter of days, then weeks. Price cuts followed, subtle at first, just enough to attract attention without signaling weakness. Yet each reduction carried meaning. It suggested that the original price had been too optimistic, that the pool of willing buyers was smaller than expected. Buyers, for their part, were no longer acting out of urgency. They hesitated. They compared options. They walked away from deals. For the first time in years, they had leverage and they knew it. The shift in interest rates accelerated everything. Monthly payments rose sharply, even as home prices remained elevated. Affordability, already stretched, began to break. Buyers who could once qualify for a loan found themselves priced out overnight. Others recalculated their budgets and chose not to stretch as far as they once would have. The math no longer supported the emotion. What had been a demand-driven market began to lose its foundation. Sellers faced a new reality, one that many were unprepared for. For years, pricing a home had been straightforward. Look at recent sales, add a premium, and expect competition to push the final number even higher. But now, comparable sales reflected a different moment, one when demand was stronger, financing was cheaper, and buyer psychology was fundamentally different. Those numbers no longer applied. Homes listed based on past conditions struggled to attract interest. Sellers who refused to adjust found their properties sitting unsold, accumulating days on market that signaled weakness to potential buyers. Each passing week reduced negotiating power. Each price cut confirmed that the market was no longer moving in their favor. Yet many resisted. Anchored to peak valuations, they viewed lower offers as unacceptable rather than realistic. Some chose to withdraw their listings altogether, deciding to wait for better conditions. Others rented their properties, hoping to hold on until prices recovered. These decisions slowed the visible decline but did not stop it. They merely delayed the adjustment. Behind the scenes, inventory was building. Not all of it appeared in official counts. Some homes remained off-market, held back by owners unwilling to sell at current prices. Others were listed and relisted, creating the illusion of new supply when, in reality, they represented unsold inventory cycling through the system. The true level of supply was higher than it seemed, and it was growing. At the same time, the composition of buyers was changing. Investors, once a dominant force, began to pull back. Rising financing costs reduced profit margins, while uncertain price trajectories increased risk. Deals that once made sense no longer worked on paper. Without investor demand, the market lost one of its key supports. First-time buyers, often the most sensitive to affordability, faced increasing barriers. Higher rates, elevated prices, and economic uncertainty combined to limit their participation. Many stepped aside, choosing to wait rather than commit under unfavorable conditions. The result was a market caught between expectations and reality. Sellers expected prices to remain near their peak. Buyers expected prices to adjust downward to reflect new conditions. Transactions slowed as these expectations failed to align. Volume declined, even in areas where prices had not yet fallen significantly. The lack of activity itself became a signal, evidence that something was changing. In previous cycles, similar patterns had preceded more visible corrections. A slowdown in sales often came before a decline in prices. Behavior shifted before valuations did. By the time price indices reflected a downturn, the underlying change had already taken place. This time was no different. The narrative, however, lagged behind the reality. Headlines continued to highlight resilience, pointing to limited inventory or strong employment as reasons the market would remain stable. These arguments were not entirely wrong, but they were incomplete. They focused on static factors while ignoring dynamic ones, changes in behavior, shifts in sentiment, and the cumulative impact of affordability constraints. Markets are not driven solely by fundamentals. They are driven by participants, and participants respond to changing conditions in ways that are not always immediately visible in the data. By the time those responses become measurable, the direction is already set. In city after city, the same quiet transformation was underway. Not a collapse, not yet, but a transition. The kind that begins slowly, almost imperceptibly, and then accelerates once certain thresholds are crossed. The breaking point is rarely obvious in the moment. It is only clear in hindsight, when the signs that once seemed minor reveal themselves as the beginning of something larger. And by then, the market has already moved on. The change became harder to ignore once prices stopped holding their ground. It did not begin with dramatic declines or sudden collapses. Instead, it started with hesitation in the data, months where growth slowed, then stalled, then quietly reversed. At first, the adjustments were small enough to be dismissed. A fraction of a percentage point, a seasonal dip, a temporary correction after years of rapid appreciation. But the pattern did not correct itself. It repeated, then deepened. In certain cities, the shift appeared earlier and more clearly. These were places where the boom had been strongest, where prices had risen the fastest, and where affordability had been stretched the furthest. The same forces that had driven them upward now worked in reverse. Demand, once overwhelming, thinned quickly when financing costs increased. Buyers who had stretched to enter the market found themselves unable or unwilling to do so again at higher monthly payments. Listings in these areas began to accumulate, not all at once, but steadily enough to change the balance. Sellers who had delayed entering the market now faced competition not just from new listings, but from properties that had already been sitting unsold. Each new listing no longer entered an environment of scarcity, but one of growing supply. Price reductions became more frequent and more visible. What had once been quiet adjustments turned into necessary strategies. Sellers lowered prices not to maximize profit, but to generate interest. In many cases, even that was not enough. Homes lingered. Offers came in below expectations, sometimes significantly below. Negotiation, once rare, became standard. The psychology of the market shifted alongside these numbers. Buyers, observing the changes, grew more cautious. The urgency that had defined the boom faded. Instead of rushing to secure a property at any cost, they waited. They watched. They expected better opportunities ahead. Each price cut reinforced that expectation, encouraging further patience. This feedback loop began to shape the direction of the market. In areas where investor activity had been highest, the effects were amplified. Investors, unlike primary homebuyers, tend to respond quickly to changes in profitability. When appreciation slows and financing costs rise, the margin for error disappears. Properties that once promised steady returns now carried uncertainty. Many investors chose to exit or pause their acquisitions, reducing a significant source of demand. Some attempted to sell into a weakening market, adding to supply. Others held onto their properties, but without expanding their portfolios. In both cases, the effect was the same: less upward pressure on prices and more inventory competing for a shrinking pool of buyers. Meanwhile, the rental market, which had absorbed much of the investor-driven supply, began to show its own limits. Rent growth slowed, then stabilized, then in some areas declined. The assumption that rising rents would offset higher purchase costs proved unreliable. For investors relying on rental income to justify acquisitions, the numbers no longer aligned. The result was a market losing multiple layers of support at once. Builders, too, faced a shifting landscape. During the height of the boom, new construction had surged to meet demand. Projects were planned and financed based on assumptions of continued growth, strong buyer demand, stable financing conditions, and rising prices. But by the time many of these homes were completed, the market they were entering had changed. New homes, often priced at a premium, struggled to attract buyers. Builders responded with incentives, rate buydowns, upgrades, closing cost assistance. These measures helped, but they also signaled a change in conditions. When incentives become necessary, it suggests that pricing alone is not sufficient to drive demand. In some cases, builders reduced prices directly. In others, they slowed or halted new projects, waiting for clearer signals. Construction pipelines adjusted, but not immediately. There is always a lag between decision and outcome, and during that lag, supply continued to arrive. As inventory increased and demand softened, the balance of power continued to shift. Data began to reflect what participants had already sensed. Price indices showed declines in certain regions, particularly those that had experienced the most rapid growth. The decreases were not uniform. Some cities saw modest adjustments, others more pronounced, but the direction was consistent enough to draw attention. Even so, the broader narrative remained cautious. Many analysts pointed to structural factors, limited long-term housing supply, demographic demand, and relatively strong economic conditions as reasons the market would stabilize rather than decline significantly. These arguments held weight, but they did not fully account for the speed at which sentiment can change. Housing markets are slow to turn, but once they do, they tend to follow through. In previous cycles, the early stages of decline were often characterized by disbelief. Sellers resisted lowering prices. Buyers waited for further declines. Transactions slowed as both sides adjusted to new expectations. This period, sometimes referred to as the stall phase, can last for months or longer, creating the impression of stability even as underlying conditions weaken. But stability during this phase is often temporary. As time passes, external pressures begin to accumulate. Financial constraints, life events, and market realities force decisions that can no longer be postponed. Sellers who once had the option to wait eventually need to act. Buyers, sensing opportunity, re-enter the market selectively, but on different terms. This is when price discovery begins in earnest. Comparable sales start to reflect the new environment. Lower-priced transactions become the basis for future listings. Appraisals adjust. Lenders respond to updated valuations. The entire system recalibrates, not suddenly, but persistently. In some cities, this process moved faster than in others. Areas with high levels of speculative activity or extreme price growth saw more immediate corrections. In these markets, The gap between peak pricing and current demand was too large to sustain. Adjustments were not gradual, they were necessary. In more stable regions, the changes were less dramatic but still present. Prices flattened, then edged downward. Activity slowed. The same underlying forces were at work, even if their effects were less visible. What connected all these markets was not the magnitude of change, but its direction. The housing boom had been driven by a convergence of factors: low rates, strong demand, limited supply, and positive sentiment. As those factors reversed or weakened, the conditions that supported rapid growth no longer existed in the same form. The breaking point, once approached, had been crossed in certain areas. And once crossed, the process was difficult to reverse. Markets do not simply return to previous conditions because participants want them to. They respond to current realities: affordability, financing, supply, and expectations. When those realities change, the market adjusts accordingly, regardless of prior trends. By the time this adjustment becomes widely acknowledged, much of it has already occurred. The early signs, once subtle, are now visible. Price reductions, increased inventory, slower sales, each one a piece of a larger pattern. Together, they form a clear signal that the market is no longer in expansion, but in transition. And in some places, that transition has already begun to resemble something more definitive. Not just a slowdown, but the early stages of a decline. The shift from slowdown to decline did not require a dramatic trigger. It unfolded through pressure, gradual at first, then increasingly difficult to ignore. What had once been a market defined by choice began to feel constrained by necessity. Decisions that sellers could once delay became unavoidable, and the reasons behind those decisions revealed a deeper layer of the market's vulnerability. In the earlier phase, many homeowners had the option to wait. They could hold their properties off the market, rent them out, or simply delay selling in the hope that conditions would improve. But time introduced complications. Adjustable-rate mortgages began to reset at higher rates. Monthly payments increased, sometimes sharply, eroding financial flexibility. What had been manageable under previous conditions became burdensome. At the same time, broader economic pressures started to emerge. The labor market, which had remained relatively strong during the initial stages of the housing slowdown, began to show signs of strain. Layoffs, though not widespread at first, appeared in specific sectors, particularly those that had expanded rapidly during the boom years. Technology, finance, and construction all experienced periods of contraction, and with each wave of job losses, the housing market absorbed the impact. For homeowners affected directly, the situation changed quickly. Income disruption reduced their ability to carry mortgage payments, especially at higher interest rates. Savings, if available, provided only temporary relief. The decision to sell was no longer strategic, it was necessary. This marked a transition into a different phase of the market. Listings driven by necessity behave differently from those driven by opportunity. Sellers in this position are less focused on maximizing price and more concerned with timing and certainty. They are more likely to accept lower offers, to negotiate more aggressively, and to prioritize closing over holding out for better terms. As these listings increased, they began to influence comparable sales. Lower transaction prices, once isolated, became more common. Appraisals adjusted accordingly, reinforcing the downward trend. Each sale at a reduced price established a new reference point, affecting the expectations of both buyers and sellers. The effect was cumulative. At the same time, a segment of homeowners found themselves in a more precarious position. Those who had purchased near the peak of the market, often with minimal down payments or aggressive financing terms, faced the risk of negative equity. As prices declined, the value of their homes approached, and in some cases fell below the balance of their loans. Negative equity changes behavior in fundamental ways. It removes flexibility. Homeowners can no longer sell without incurring a loss, which limits their options. Some continue to hold on, hoping for a recovery. Others, facing financial pressure, are forced to make difficult decisions. Distressed sales, while not yet dominant, began to appear with greater frequency. Foreclosures, too, followed a similar pattern. They did not surge immediately. There are delays built into the process, missed payments, notices, attempts at modification, and legal procedures. But once initiated, they add to the supply of homes entering the market under less favorable conditions. These properties often sell at discounts, not necessarily because of their intrinsic value, but because of the circumstances surrounding them. Their presence contributes to price discovery at lower levels, reinforcing the overall direction of the market. Meanwhile, buyers continued to adapt. The expectation of declining prices became more widely accepted. What had once been a cautious assumption turned into a working belief. Buyers adjusted their strategies accordingly. They offered less. They negotiated more. They walked away more easily. In some cases, they delayed purchasing altogether, convinced that better opportunities would emerge. This shift in buyer behavior further reduced demand at current price levels. The interaction between motivated sellers and cautious buyers created a new dynamic. Transactions still occurred, but increasingly at prices below recent comparables. Volume, while still lower than during the boom, began to stabilize at these reduced levels. The market was finding a new equilibrium, but at a lower point. In certain regions, the pace of decline accelerated. Areas with higher concentrations of recent buyers, investor-owned properties, or economic exposure to volatile industries experienced more pronounced effects. In these markets, the overlap of financial pressure and reduced demand created conditions where prices adjusted more quickly. Inventory in these regions rose not just in quantity, but in urgency. Listings accumulated, but so did the need to sell. Price reductions became sharper, more frequent. Time on market extended further. The gap between initial listing prices and final sale prices widened. Builders facing their own constraints contributed to the adjustment. Unsold new construction added to supply, often with incentives or price cuts that influenced surrounding markets. In some cases, builders accepted lower margins to move inventory, prioritizing liquidity over profitability. The presence of discounted new homes placed additional pressure on resale properties, particularly those competing within similar price ranges. Financial institutions, while more cautious than in previous cycles, were not immune to the changing conditions. Lending standards, already tightened, remained restrictive. This limited the pool of qualified buyers, reinforcing the demand constraints already present in the market. At the same time, appraisal practices reflected recent sales data, which increasingly included lower-priced transactions. This created a feedback loop where declining prices influenced financing outcomes, which in turn affected future transactions. The system adjusted step by step. Public perception began to catch up with reality. Reports of declining prices in specific cities gained attention. Analysts revised forecasts. Discussions shifted from whether the market would slow to how far it might decline. The tone changed, gradually but noticeably. Yet even as awareness grew, the process continued. Housing markets are not instantaneous. They move through phases, each building on the previous one. The transition from growth to decline involves shifts in behavior, pressure, and expectations. By the time these elements align, the direction is already established. The breaking point, once crossed, leads to consequences that unfold over time rather than all at once. What had begun as a subtle change in activity had evolved into something more concrete. Prices were no longer stable. Sellers were no longer in control. Buyers were no longer reacting, they were anticipating. And the market, shaped by these forces, continued to move. Not abruptly, but steadily. Not with panic, but with persistence. Toward a lower level than it had reached at its peak. The final phase did not arrive with a sense of resolution. There was no clear moment when the decline ended and stability began. Instead, the market slowed into a different kind of stillness, one that felt less like balance and more like exhaustion. After months of adjustment, of shifting expectations and incremental declines, the pace of change itself began to ease. Not because the underlying issues had been fully resolved, but because much of the immediate pressure had already worked its way through the system. By this stage, the most urgent sellers had already acted. Properties driven by necessity, those influenced by financial strain, job loss, or unsustainable payments, had largely moved through the market. Their impact, however, remained embedded in the data. Lower comparable sales had reset pricing expectations across entire neighborhoods. Appraisals reflected this new baseline. The market, having absorbed the initial wave of decline, began to operate within these adjusted boundaries. Buyers who had spent months observing the shift approached the market differently now. The expectation of rapid declines gave way to something more measured. Opportunities still existed, but they were no longer as obvious or as frequent. The sharpest corrections had already occurred in the most vulnerable areas. What remained was a market searching for direction rather than falling in a straight line. Transaction volume, which had dropped significantly during the earlier phases, began to stabilize, not at the levels seen during the boom, but at a point where activity felt sustainable under the new conditions. Homes still took longer to sell. Negotiations remained part of the process, but the gap between buyer and seller expectations narrowed enough to allow deals to move forward with greater consistency. In this environment, pricing became less volatile. Declines, where they continued, were more gradual. In some regions, prices appeared to flatten, moving sideways rather than downward. This did not signal a return to growth, but rather a pause, a period where the market absorbed previous changes and tested the strength of its new equilibrium. For many homeowners, this phase brought a form of reluctant acceptance. The peak valuations of the boom were no longer the reference point. Instead, decisions were made based on current conditions, even if those conditions were less favorable than what had once seemed possible. Sellers priced more realistically from the outset. Buyers evaluated purchases with greater caution, focusing on long-term affordability rather than short-term competition. The psychology of the market had changed. Where urgency once dominated, patience now prevailed. Where fear of missing out had driven decisions, a concern about overpaying took its place. This shift did not eliminate activity, but it reshaped it. Transactions were fewer, slower, and more deliberate. At the same time, the broader economic context continued to influence the housing market's trajectory. Interest rates, having risen significantly, remained a central factor. Even small changes in borrowing costs affected affordability, influencing both demand and pricing. While some hoped for a rapid return to lower rates, the reality proved more complex. Financial conditions adjusted gradually, and expectations adapted alongside them. Employment conditions also played a role. While the initial waves of layoffs had contributed to the earlier phases of decline, the labor market did not collapse entirely. Instead, it moved through its own cycle of adjustment. Stability in employment helped prevent a more severe downturn in housing, even as it limited the pace of recovery. This balance between constraint and support defined the market's new position. Not all participants experienced this phase in the same way. For those who had purchased early in the boom or before it began, the impact was often manageable. Even with price declines, many retained equity and the ability to hold their properties. For these homeowners, the downturn represented a reduction in paper value rather than a direct financial crisis. For others, particularly those who had entered the market near its peak, the outcome was more challenging. Reduced home values limited mobility. Refinancing options were constrained. In some cases, losses were realized through sales made under pressure. The timing of entry, as in all market cycles, played a significant role in determining outcomes. Investors, too, faced a recalibrated landscape. The strategies that had worked during the boom, rapid acquisition, reliance on appreciation, aggressive leverage, were less effective in this environment. Returns depended more heavily on fundamentals, rental income, cost control, and long-term positioning. Some investors adapted, focusing on sustainable models. Others reduced their exposure, reallocating capital to different opportunities. Builders adjusted as well. New construction slowed, aligning more closely with current demand. Projects were planned with greater caution. The rapid expansion of the boom years gave way to a more measured approach, one that reflected the lessons of recent volatility. Over time, these adjustments contributed to a gradual rebalancing of the market. Supply and demand, while not perfectly aligned, moved closer to equilibrium. Excess inventory was absorbed, either through sales or through decisions to hold properties off the market. New supply entered at a slower pace, reducing the pressure on existing listings. Yet even as stability emerged, the memory of the boom and its collapse remained influential. Participants carried those experiences forward, shaping future decisions. Buyers were more cautious about stretching beyond their means. Lenders maintained stricter standards. Investors evaluated risk with greater attention to downside scenarios. The collective behavior of the market, informed by recent history, became more restrained. This is often how cycles leave their mark, not just through changes in price, but through changes in behavior. The housing boom had been driven by confidence, by a widespread belief in continued growth and limited risk. Its collapse, gradual as it was, introduced a counterbalance to that belief. It reminded participants that markets can move in both directions and that conditions supporting rapid growth can shift. In the years that follow, new trends would emerge. Demand would evolve with demographics and economic conditions. Supply would respond to long-term needs. Prices would find new paths, influenced by factors both familiar and unexpected. The cycle would not end, it would transform. But the breaking point would remain a reference. A moment not defined by a single event, but by a series of changes that, taken together, altered the direction of the market. A period when momentum gave way to reality, when expectations adjusted, and when the structure of the housing boom revealed its limits. By the time it was fully understood, it had already passed. What remained was not the collapse itself, but its consequences, embedded in prices, in policies, and in the decisions of those who had experienced it. And in those consequences, the foundation of the next cycle was quietly taking shape. And if you think this cycle is over, history suggests it's only beginning again.